Good morning and welcome to today's market briefing. Let us start with a quick recap of the weekend. U.S. stock markets were closed on Sunday, so there were no actual changes in the three major indices. The Nasdaq closed at 26,517.93, the S&P 500 at 7,558 and the Dow at 51,564.70, all reflecting last Friday's closing levels. Pre-market futures are flat, indicating no clear directional signal for today's open. On individual stocks, Nvidia closed at $210.69, Tesla at $449, the Bitcoin ETF fell 2.39% to $35.62 and MicroStrategy dropped 5.14%. Back to Friday's share market, the Shanghai Composite slipped 0.43% to 409.48, the Shenzhen Component rose 0.94% and the Chinex surged 2.05% to 4,252.39 points, a clear case of tech and growth stocks leading the way. Now let us look at the global macro picture. The 10-year Treasury yield is hovering around 4.45%, showing a sideways trend. It edged lower last week, reflecting a more stable view on Federal Reserve policy with no clear signal of tightening or easing. The VIX Fear Index stands at 1678, well within the normal range of 15 to 25. Sentiment is neither panicked nor greedy and the market is in a wait-and-see mode. The dollar index is at 185, remaining weak. This weakness has been a key backdrop for capital flows into emerging markets and precious metals. If it breaks below 100, we could see a further shift toward risk on trading. WTI crude oil is trading around $76.54 after dipping below $75 last week before bouncing back. The $75 level is a critical short-term support. If it holds, the rebound can continue, but if it breaks, we could see a faster decline. Gold remains in a high-level consolidation zone between $4,100 and $4,200, with the weak dollar providing a solid floor. Overall risk appetite continues, but the heat has moderated somewhat, putting us in a normal to slightly positive zone. The conditions for a change would be if the VIX climbs back above 20 this week, or if WTI breaks below $75 and fails to recover. In that case, risk sentiment could turn cold quickly. On the currency front, the onshore yuan is at 676.81 and the offshore yuan at 7,812, with very narrow daily moves and no significant depreciation pressure. The yuan remains stable, which provides a solid foundation for foreign capital flows into shares. If the yuan can strengthen further towards 670 this week, we could see an acceleration of northbound capital inflows. Over the weekend, a major development occurred. The U.S. Commerce Department issued its final rule on AI chip exports to China, maintaining strict restrictions on high-end chips while adding some licensed exceptions for trusted end users. In response, China's Ministry of Commerce announced export controls on gallium, germanium, antimony and key rare earth-related materials, targeting permanent magnet raw materials. The measures take effect in 30 days. Meanwhile, TSMC's Arizona plant has begun trial production of 4-nanometer chips. Given these simultaneous restrictions, shares are likely to open flat to slightly lower today. The rare earth and strategic metals sectors will see clear upside catalysts, while semiconductor and AI computing stocks may face pressure. If the Shanghai Composite opens higher with strong volume during the auction session, we would revise our view to a weak consolidation scenario. For today's share market, the Shanghai Composite is expected to trade in a range of 4,050 to 4,120 points. The Chinex will see internal divergence with AI chips under pressure, but new energy storage and materials sectors potentially stepping in to support a relatively strong performance. If the Shanghai Composite breaks below 4,050 and fails to recover within 30 minutes, we would turn bearish. The most active sectors today are likely to be rare earths and critical minerals, as well as power equipment, specifically energy storage and grid infrastructure. The former is directly driven by the weekend's export control retaliation, with magnetic materials and gallium germanium suppliers offering event-driven certainty. The latter benefits from extreme heat and rising electricity demand from AI data centers, making the energy storage and transformer story a continuing theme. On the risk side, avoid semiconductor materials and foundry stocks that rely on U.S. equipment and technology. The new U.S. AI chip rules reinforce the decoupling narrative, putting pressure on valuations in these names. TSMC's Arizona trial production will not ease the revenue gap from China in the short term, adding to sector uncertainty. For northbound capital, the weekend's regulatory tug-of-war has intensified, but with the yuan stable we expect roughly equal chances of net inflows and outflows today. The direction will depend on whether the rare earth sector can generate enough profit-taking to attract capital. If the Shenzhen Stock Connect sees net inflows exceeding 15 billion yuan in the first 30 minutes, we would upgrade our outlook to net inflows. Here is our core judgment for today. As both sides escalate their controls simultaneously, supply chain restructuring is giving birth to a new main line, with rare earths and power becoming the safe havens of the short term. Our probability assessment stands at 30% for an up day, 45% for a sideways day, and 25% for a down day. Thank you for watching, and we will see you in the next session.